Investors digesting the latest round of Fed speak. Cleveland Fed President Loretta Mester offering a cautious outlook this week, saying, quote, that if the economy evolves as expected, I think we will gain that confidence later this year, and then we can begin moving rates down. Now, this comes after Fed Chair Jay Powell signaled that a March rate cut is essentially off the table. We want to bring in Ellen Hazen, F.L.Putnam Investment Management Strategist, breaking down exactly what this means for investors. Ellen, when you take into account the Fed speak that we're getting, the fact that it is very unlikely we are going to get a rate cut here at the next meeting in March, and then stack that up against earnings season so far, overall better than expected. What's the biggest driver here for stocks in the short term?
Thanks, Shauna. Looking in the short term, we think that earnings are going to continue to be the growth driver. Whether or not the Fed cuts rates later this year is still very much up in the air. Irrespective of Ms. Mester's comments yesterday, I think the Fed is trying to keep optionality for the rest of the year. They've made it quite clear that March is unlikely, but could they cut in May or later in the year? I suppose, but I don't think that's going to be the biggest driver of stocks. I think earnings is going to continue to be the biggest driver of stocks. And what we're likely to see is a continuation of the trend that we've seen for the last 9 months, which is earnings growth on a year-over-year basis bottomed in Q2 of 2023. It was flat in Q3. It was up in Q4 so far, and it looks as though it's going to continue to accelerate. So if the economy stays solid, as it has been with jobs and unemployment showing such strong gains as they have over the last few months, then earnings are going to drive stocks, and earnings right now look pretty good.
Ellen, is there anything not to like in these earnings reports that we've been hearing so far? We have seen some weakness, at least when it comes to some of the regional plays and some of the bigger banks in terms of their forecast. Does that cause any concern for you?
It's really very company specific. So you've seen some companies have really negative earnings reports, and the stocks that have been more expensive to start with have gotten hit. So you saw Rockwell Automation was one, had a tough earnings report, and that stock had really gotten ahead of itself. Same thing with Air Products. So there are companies that have had weaker earnings or weaker forecasts. And when the stocks were expensive, then they had significant negative stock response. But then you look at a case like CVS, where they lowered guidance for the year this morning, and yet that stock is actually up. So a lot of it depends on the starting valuation, and starting valuation matters with a lot of these areas. It's really stock by stock. As it refers to the big banks, certainly New York Community Bank is in a league by itself at the moment. We think the big money center banks like JP Morgan, Bank of America, Citigroup are fine. We are concerned about the regional banks and the commercial real estate exposure that they have. So we're not active in the regional banks right now for that reason. A lot of them are pretty cheap, so they look interesting, but we want to wait and let the commercial real estate settle out before making any moves there.
Are there certain weak spots that you would feel more comfortable buying into in this market, Ellen?
It really depends on valuation, Brad, again. So in the healthcare sector, there are some stocks that are pretty cheap, particularly some of the healthcare insurance companies like a Humana look pretty inexpensive. And so if the starting valuations are cheap, then they can absorb a little bit of bad news. And healthcare really had a tough year last year, even though a lot of the fundamentals are pretty good. So that's one area that we think looks interesting. But then again, you look at some of the tech stocks that have had disappointments, like Snap, for example, you were talking about earlier, where the valuations are stretched and the stocks have done so well, we're a lot more cautious. One area we do like, though, is semiconductors going forward. And that's true across the board, not just NVIDIA, but a lot of those companies are reasonably valued. They're not really stretched here. And we saw the numbers from TSMC this morning, overnight, where their January sales were up 8% year over year. So that's pretty positive. In terms of the semiconductor inventory cycle, looking like it is coming to an end, and that will be good for the stocks.
All right, NVIDIA striking a $1.7 trillion market cap this week as of right now, trading just below $700 there. Ellen, thanks so much for taking the time here. Ellen Hazen, who is the F.L. Putnam Investment Management Strategist. Appreciate it.
Thanks, Brad.
You got it.